Hello, I'm Jonathan Hall. That is Brian Grant. We are financial advisors with Warburton Capital. Brian, whether we are in the conference room working with clients or recording this podcast, our goal is the same, to help people manage their wealth, have a purpose defined for that wealth, and then have that purpose lead them towards a life of peace.
Mm-hmm. Yeah. This is a good one. This is maybe the most ubiquitous topic. This applies to almost
Big word alert.
It's big word podcast.
Yeah, man.
I was feeling fancy. Should you max out your 401k, right? Or how much should I put in my 401k? We get asked that all the time. 401k is probably the most common account that people are going to have accessible to them, whether we're working with an advisor yet or not. Just most jobs, if they're going to have a retirement plan anymore, it's not a pension, it's a 401k.
Sure.
So how much should I put into it? Should I max it? Should I put nothing and divert to other goals? I think like most questions on this show, it'll depend.
Absolutely.
But we want to think through it a little bit with people. So where do you want to start? Just what are the options?
Well, I think I'd like to start with the match. Let the match be your guide, at least for starting. So I used to teach a personal financial planning class at a local university here in Tulsa. And I remember trying to think through if I had 3 or 4 takeaways that I would send these kids home with at the end of the school year. Because how much of your college classes do you remember by the end of it, right? It's like you get a handful of nuggets from each class, and that's what you carry with you. And so for that class, one of the big nuggets I wanted them to take away was always take the employer match. If you think about it, and if that's the one nugget that our viewers and listeners get from this podcast, that's okay. Always take advantage of the employer match.
Yeah.
There are very few other places in finance, in your personal financial life, where you can get a 100% return on your money in a lot of cases. So, for example, to break it down, if you put in 3% of your salary and you decide to defer that into the traditional side of your 401k, then if there's a 3% match, your employer will also put 3% of your salary in there. They're not going to take that away from your salary. They're adding that on top of your salary. So your take home doesn't go down by more because of the match or anything like that. So if you think about it, if you put in, let's say $1,000, for example, over some time period, and they also put in $1,000, I'm not a math genius, but that's a 100% return on your money. No matter what it's invested in, you just experienced a great return.
Right. Yeah. No, it's essentially deferred compensation, right? It's part of your comp that you're leaving on the table if you don't do it. So 100%. I think the floor should be enough to get the match if it's feasible. There are exceptions to every rule,
Of
right?
course.
So maybe there's a reason you don't for a little while contribute. But as a general rule, try to at least get the match. I think another thing, the big thing that comes to mind that I don't want to forget is figure out how your match works. So almost no one we talk to very few people are like, oh yeah, it's this. Sometimes it's really simple. You put in 5%, the employer matches 100% on the first 5% you put in. That's simple. You put 5, you get 5. Some of them, it's a little different. It's we'll match 100% of the first 3% and then 50% of the next 3%. And so to get the full match of 4.5%, you've got to put in 6. So you need to do some math. You need to understand how it works to get the full amount you can. But I agree. I think the floor should be the match. It's free money. It's 100% return, however you want to think of it. But what you invest in, all the other things are downstream from that first point of let me just at least get the additional wages, essentially, that my employer is offering me.
Absolutely. When you're starting in a new job, a lot of times that first couple of weeks, you're drinking from the fire hose. You're learning everything about this new company, this new employer. You're trying to make sure that your doctors are on the health insurance. There's a lot going on. The 401k, we found in our experience, often falls to the kind of bottom of the priority list. Yeah, I'll just sign up and whatever. That's okay for a time. But to your point, we have seen clients accidentally missing out on the match, and you can't necessarily go back and get it, right? So that would be our starting point, is to consider putting enough in to get the match because it's free money.
Right.
Where do we go from there, Rob?
I mean, the opposite end of the spectrum is maxing it, right? And I don't want to, the whole episode could get caught up in the minutia of what the IRS rules are. If you're under 50 this year, you could put in up to $24,500. That's what you could defer from your salary. So your percentage, if you were going to max it, depends on what your salary is, right? More money can go in from employer matches or from other things up to a limit. There's catch-up contributing. I mean, there's a ton of rules. You can contribute more if you're over a certain age. But for most people, for younger folks at least, 24.5 is starting is the max rather. So does that make sense? I mean, sometimes it does.
Mm-hmm.
You know, if you're a high enough earner, particularly to where you know it makes sense to defer to the traditional side and get the pre-tax savings now, and maybe we'll touch on that more next. But then it might make sense to max it out, right? Or it might. But what we often find, I think, what we want to try to talk about is maybe there are cases where people are saving effectively, like they have a good savings rate as a percentage of their overall income and how much they're saving every month or every year. But are they over saving to, let's say in this case, the retirement goal by maxing out the 401k and under saving to some of these other more near-term goals?
Sure.
And that's actually more common than you'd think. I can think of several people who are mid to late 30s, started a job when they were 22, making decent money. They make more now, and they've maxed it out or contributed heavily every year, and they have a significant 401k balance for somebody in their mid-30s. But they have little emergency fund, few brokerage assets. The 529s for their kids are kind of underfunded, so they're going to have to cash flow college. Like, on paper, their balance sheet looks really strong, but a lot of it's inaccessible until after 59 and a half. So maybe we get into that a little bit.
Well, that's a concept that we walk through with our clients called asset location.
Mm-hmm.
We have these assets. That's great. Where are they? And what are the tax treatments of each of these individual accounts? For example, I think that that's an area where working with a financial advisor can be extremely helpful because we know the ins and outs of the tax treatment of each of these different types of accounts. That could be a whole episode or a series of episodes in and of itself, but there's different tax treatment for when the money goes in. Is it pre-tax? Is it post-tax? And then how the money grows over time. And then when you take it out, how old do you have to be to take it out? With a 401k, what conditions have to be met in order for you to take it out? And then what is the tax treatment of taking it out? Are you taxed on just the growth? Are you taxed on the whole amount? Is there no tax? That really depends on where you put the money in the first place. So we kind of have to be able to look down the road. So many of our financial decisions that we make are made for today. In order to build a proper financial plan, we have to be able to look down the road to the future, not to try to guess what the market's going to do, but to try and see where do we think our assets are going to line up in the future? Mm-hmm. How much do we think we'll have in a brokerage account, in a Roth account, in a traditional 401k account? Because if we get to retirement and they're all in one type of account, which we've seen that, mm-hmm. where we'll get to retirement and all of a client's assets are in a traditional 401k or a traditional IRA, mm-hmm. it's not the worst thing ever. One of my favorite clients who I think is having the best retirement ever, mm-hmm. their portfolio looks like that. And it's okay, mm-hmm. but it does limit their flexibility year to year from a tax perspective.
Right. Right. So even to your point, even at retirement, even if we make it to 59 and a half where there's no penalties or anything, right? If you have $5 million liquid and it's all in qualified assets that are going to be taxed at ordinary income when you pull them, that makes, just as an example, it makes one-offs a little more stressful, right? You want to pull out $100,000 and maybe your portfolio from a dollar amount perspective can sustain it for this big trip you want to take, or
you want to buy a lake house.
Yeah, or an addition to your house, whatever the deal. Mm-hmm. But like now you're going to pay ordinary income on an extra $200,000 on top of the $200,000 or $250,000 you were already pulling out that year to live. Like, so there's some limitation on sort of your tax flexibility, your ability to control your tax picture in retirement. my mind just keeps going back to pre-retirement, like the limitation of your flexibility. Because again, like it's not impossible if you're that person that graduated at 22, you started a job, you love it there, you worked there for 30 years, and now you're 52, you might have enough on paper to retire and sustain your lifestyle. But some of it or all of it might be inaccessible. And so you just, you limit your ability to do what you otherwise might want to do and have enough money to do just because you kind of over contributed to one account type. Because that upfront tax savings maybe was attractive, or it was just the easy way to save, or you didn't know what to do. So, I mean, and again, like better to be that person than just not save for retirement. You know what I mean? I'm not
Sure.
I'm not saying don't do that. But I think the point is for most people, contributing just enough to get the match or contributing, the max amount is not always the answer. I think most people live somewhere in that gray space in between, and that nuance is a lot easier to be fleshed out when you have someone objective that you're working with who can kind of say, hey, in light of XYZ that you told me, that's in the next 3, 4, 5, 10 years, which is pre-retirement, we might want to do this amount to our 401k, drop it a little bit actually. You're still getting the full match, but now we can put enough in our 529s that you don't have to worry about how you're going to pay for college. Or we can put enough in the brokerage account that if early retirement becomes feasible, you've got a bridge till you're 60, right? Like, so that's where that, there's more planning opportunity, I think, than people realize when that question is posed.
The 401k is the most automatic way to save for the future and get into the stock market. For a lot of people, it's the only way that folks are saving for the future and getting money into the stock market. So in that way, it's kind of a modern miracle that we have this thing, right? That it automatically starts to take money from our paycheck and put it into an investment account and invest it for us. That's a really positive thing. The downside is when you get to a point where your financial planning no longer needs to be automatic, but it needs to be specific, that's where it can really start to make sense to speak with a financial advisor and think about what your unique future looks like. One of the things we talk about on this show a lot is the tension between today and tomorrow, right? We've got this decision to make. Do we spend money today? Do we save it for the future, right? Do we put it in an account type that gives us immediate tax relief, or do we put it in an account type that helps us with our taxes going forward, right? And there's just always this tension between the two, today and tomorrow. Walking that line and navigating it is something that we enjoy getting to help clients think through, because there is not one perfect answer. There's no podcast or video that you can go watch that's going to give you the specific answer that you need. That's where working with an advisor who's making a plan just for you can be really helpful.
Yeah, for sure. A couple of things, I don't know how these fit, but that I want to mention because I could just see questions. One is real simple. Like, we're talking about how many dollars to put in. Know what you're investing in within it, right? I mean, and plans have come a long way. There's usually a decent default investment that they put you in if you don't pick anything. It's usually a target date fund. Those are reasonable. That could be a whole episode. Point is, know what you're investing in every month. Like, you don't want it, God forbid, sitting in cash or bonds from 22 to 52, and you did the right thing behaviorally, but you just didn't do that extra step of knowing how it was invested. So that's crucial. A lot of people then will say, okay, I have my number, traditional or Roth. Like, do I do the pre-tax or do I pay the tax now? To your point, that could be easily a whole episode. I think there's a couple really obvious case scenarios probably that, short of other details that might sway me, I'd say there's a clear answer. If you're 22, if you're that new grad and you make 50 grand, 60 grand a year, it probably makes a lot of sense for you to contribute your deferrals to the Roth side. Pay the tax now. You're probably in a lower tax bracket than you're ever going to be, and pay the tax, be done with it. Now you have a bucket that's tax-free later on. If you're 45 or 50 and you make $500,000 a year, once your marginal tax rate is 32% or higher. Honestly, that's kind of where it gets harder to justify the Roth side. Unless there's there's kind of that third scenario, like maybe you're 60 and you already have a $4 million 401k, or maybe 2-3 million in the 401k and $1 million from an old job you rolled over in an IRA. Like you have this huge pre-tax vehicle that you've already created. It might make sense to do the Roth side for some of your assets, even though there's that tax advantage up front. Maybe that diversification is enough, or that pool is dedicated to growing for my kids to inherit tax-free, or like, there's a ton of those little nuanced reasons. So we're focusing on how many dollars or what percentage do you contribute of your salary, but knowing what you're invested in and then making the right choice on pre-tax or post-tax money today is important too. So
the ultimate question with deciding where your contributions go, because that's what you've outlined is, okay, we're making these contributions. Where do they go? Do they go in the traditional side or the Roth? Most 401ks anymore will have both. When we started doing this, 13 years ago, it was pretty rare to see a Roth option inside of a 401k. Those are a lot more common now. So usually inside of a 401k, you'll have a traditional option and a Roth option. Not always. They'll always have the traditional option. If you have both, then the question is, which side think of it like a decision tree. Which side do we put the money in? And then once the money's in there, how do we invest it? Right? Working with a financial advisor can help you think through that. But to that first question, ultimately what we're trying to figure out is, do we think that our tax rate today is higher, lower, or the same as what our tax rate will be in retirement? A lot of assumptions going on in there. What will happen to the tax code in the future? We don't know that.
Right.
That's changed multiple times since we've been in this business.
Right.
Next, what will happen to your personal income picture over time? We can make some assumptions, but we don't necessarily know for sure. If we know that you have a ton already in traditional assets and you're always going to be pulling from that traditional IRA 401k, we might be able to assume that you're always going to be in a high tax bracket, right? And then third, what does our income look like today? Just what makes the most tax sense right now? And to your point, once you start getting into those upper echelon tax brackets, it's hard to make an argument for the Roth, because immediately, one of our advisors on the team, Isaac, laid it out this way to me once. He said, hey, if someone is in those upper echelon tax brackets and they defer into the traditional side, they should max it out if they can, as long as it's not going to really impair their lifestyle or hurt them. They should max it out because they're getting a 32% tax break on all of that marginal income. So now, see, we're no longer thinking about returns in terms of what did the S&P 500 do this year, right? A good financial planning should help you think about returns in a totally different way, where we're thinking, if I put 3% in and I get a 3% match, that's a 100% return. That if I put money in and I defer at my marginal tax rate, and my marginal tax rate is 32%, well, I'm saving 32% on that money.
Right.
So now, by making those two choices, by getting the match and by maxing out on that traditional side for this hypothetical individual we've created, he or she has just made two really strong financial choices that had nothing to do with the market, whether it's overvalued, what we should invest in, but they're making money just by using the language of the plan and the letter of the law to their advantage.
Right. Good planning and a good advisor can do a lot of things to add value that don't show up on your monthly statement. I think that's the tough part for people. It's very easy to look at the monthly statement or the annual statement and look at the return number and think, I made 20%, but I paid them 1%, and so this is the cost, right? But it's a much more difficult thing to calculate the benefit of, to your point. Like, if I'm the max tax bracket and I put 24 grand in my 401k, I just saved 9-10 grand in taxes I would have otherwise paid. Or, there's tons of pieces of advice that can save you money that don't show up on the stat sheet, let's say. So that stuff's all really important. Yeah, I don't know. I mean, my encouragement for people would just be to be more intentional with this account type, because it can be really powerful. And like most things, to your point, it's unique. Like, your number is different than my number. If you have high credit card debt or some other stuff, it might make sense to just do enough to get the match and really tackle that debt before you get more aggressive, regardless of what tax bracket you're in, right? So there's more nuance than we can cover here. Our point was kind of to outline, at least get the match. That's free money.
Mm-hmm.
Sometimes it makes sense to max it, but not always. And in that gray space in between where most people live, that's where working with somebody objective, I think, can help you come to the right decision for you personally. So that would be my big takeaway.
All right. Well, let's end on that.
Cool. See you guys next time.